put a lot of information into the videos. And this is part of the first of 2 videos on losing because of mistakes. I believe I'll be talking in February, again, in the Big Mike, the Future IO forum, about the other kinds of losses, losing just simply because of math, bad luck. But today I'm going to be talking about losing because of mistakes. In particular, the 2 main points I want to make is beginners lose mostly because of psychology and because of false beliefs. Mike talked about some of the false beliefs in his statement. And then obviously bad management. All right, so what kind of psychological mistakes do traders typically make? Well, this video is on losing trades that beginners make because of mistakes, and I'm going to talk a little bit about how to avoid or fix them. And then, as I said, I will do a webinar later on about how to handle good trades that go bad. In other words, not mistakes. You're doing everything right, but you just lose, which happens often because nothing is 100%. That second video is shorter because traders lose more money from mistakes than they do from bad luck. Okay, I want to talk a little bit about ignorance. All right, now, I am ignorant about a lot of things, so you can talk to me about some culture somewhere in the world that I've never studied, and because I don't know anything about it, I'm ignorant of it. So ignorant does not mean a low IQ, it simply means a lack of information. And when traders start out, they're ignorant. Just like I'm ignorant, you ask me how to play the violin, I'm ignorant, I don't know. Okay? However, it's a barrier to making money, and it's easy to fix by simply spending time. Mike talked about spending a lot of time studying, and it's really, really important. Common ignorant beliefs that lead to losses in trading. One big one is perfect trades exist, perfect setups exist. Every now and then people ask me, Al, you must have some secret setup that you're not telling us. Or Goldman Sachs has some secret setup, or some hedge fund has some secret setup. No, nobody has any secret setups, and there are no perfect setups. If you look at this chart, you look for the perfect setup, there are no perfect setups. Yet, if you look at the volume, it doesn't matter what market this is or what time frame it is. If you look at the volume, if you could see the volume is big on every bar. So what does that tell you? It tells you that institutions are finding reasons to buy and sell every bar, right? So, that tells you there is no perfect setup and that the day is just filled with setups. However, you have to learn how to read what the market is doing. There are setups on almost every bar, and that's why the volume is good on every bar, because the institutions see those setups, even if you don't see them. Another issue that comes up is noise. Every now and then I'll hear, that's just noise. It doesn't mean anything. There is no noise. Every tick, every bar, every instant of every chart exists because one institution thought it was good to buy and another institution thought it was good to sell. So sometimes the range is very tight like this or like this, and you can call it noise, but it's not noise. There are lots of trades in there and lots of trades in here if you know what to look for. And so whenever I hear somebody talk about noise, I think they're ignorant. They're not putting the time in to understand what the market is telling them. There are institutions taking those trades, and those institutions are not just randomly buying or selling. They're taking trades for a good reason. And, if you spend time trying to understand what's going on, all of a sudden that noise becomes very meaningful. And then another thing that I often hear is, Al, you're not taking a position. You're not saying buy. You're not saying sell. You're always talking about the bear case and the bull case. And whenever I hear that, that is a sure sign of ignorance as well. Because during 90% of the bars on any chart, a good trader can make money buying or selling. So a good trader can make money buying or selling in here, buying or selling in here, buying or selling in here. Only 10% of the bars on any chart are in a strong breakout, and then it's much easier to make money only trading in the direction of the breakout. Beginners are often wrong in picking entries. They usually focus too much on risk. On any trade, a trader needs to think about 3 variables. You always hear about risk and reward on television, but you never hear about probability. But the truth is that whenever you have a trade that has great risk reward, you're also going to have a very low probability of success. There has to be a reason for an institution to take the opposite side of the trade. And it's usually a trade-off. One side gets risk reward, the other side gets probability. And if you only focus on risk, you're ignoring reward and you're especially ignoring probability. And if you're ignoring probability, you're going to lose money. All right, so let's say a beginner sells right here, betting on a buy climax, right? You know, they often make bad management decisions. Even though they know what the right thing to do is, they'll conclude, okay, it's okay to sell here. You know, I understand two big bull bars closing on their highs or closing above the prior high, but you know, maybe this time it's different, right? And you know, they're always thinking about exceptions, which means they're ignoring probability. An exception is a low probability event, and that's exactly the wrong thing it's exactly the wrong way to think. All right, let's say a beginner comes over here and decides he's buying the top of a bull flag, which is good. You know, the market's clearly in a bull trend. It's always in long, and you're buying above a bull bar, and that is a good trade. However, beginners only think about risk, and they're thinking, oh my gosh, you know, if I lose this account, my career as a trader dies. You know, so it's basically fear of death. You know, I cannot risk much. I worked so hard to get this money. You know, my wife, my husband, you know, people will kill me if I lose money. So yes, it's a good trade, but I want to minimize my risk. So I'm going to buy here, but I'm going to put my stop right below so that I'm not risking very much. And the result, he ends up losing money on a good trade because he was only thinking about risk and using an inappropriate stop. If you're buying anywhere in here, your stop has to be down here. Even if you don't want to risk that much, that's where your stop is. And if you don't want to risk that much, don't take the trade. Another mistake that beginners often make is confusing swings and scalps. So for example, you know, Mike made the point that it's far easier for traders to make money as a swing trader than as a scalper. And a lot of times beginners will say, okay, you know, Big Mike says I should swing, so I'm gonna put on a swing trade. But then the reality is they end up managing it as a scalp. Now, a swing trade is not a high probability trade. You know, if you're taking a swing trade, you don't have a 70% chance of winning. You probably have more like a 40% chance of winning. But if you manage it like a scalp requires a very high probability of success. A scalp means a small reward relative to risk, so bad risk reward. The only way you can make money on taking a trade that has a bad risk reward profile is to have a very high probability of success. A swing trade does not have a high probability of success. So if you manage it like a scalp, you're going to lose money. So for example, that beginner buys that bull flag, pullback, and he uses the correct stop. You know, Big Mike says, you're a swing trader, this is where your stop is, okay? And that's true, that is where the stop is. But, you know, the swing trader then looks at these two bars and says, gosh, that's not a very good looking entry bar, and look at this follow through, it's really bad, okay? And then he decides, you know, I can't risk that much. You know, this is terrible follow through from this bull flag breakout. I really got to tighten my stop. So he goes in and he puts a tighter stop. And he ends up using a scalper stop. So he's taking a swing trade, and he originally had a stop in the correct place down here, but he did not like the follow through, and he decided that, you know, maybe it's better to just take a small loss and then continue to worry about risking all the way down here. In other words, the beginner sees where the correct stop is, he originally puts it in the correct place, and he uses these two bear bars as an excuse to tighten his stop and manage his swing trade like a scalp. So that's a really common problem that, you know, traders come up with excuses why they're not going to do what they intended to do originally. And the reality is they never intended to do this originally. They never intended to use this stop. You know, they were afraid to risk that much, and they were just hoping for some reason, like a bad follow through here, to use the scalper stop. So the bad follow-through, was just the excuse the trader needed. He lost his objectivity, and he could not handle the anxiety of what if it just goes all the way down and hit that stop? I don't want to risk that much. That means he was risking too much, and that means that his position size was too big. If he cannot trade a small enough position, he cannot take that trade, because you can only take this trade if your stop is down here. And if you cannot if you can't honestly rely on that stop, then you're trading too big. You can only use a stop if the risk of losing is acceptable. You have to make sure that you never lose more than what you can manage to lose. So if you enter as a swing, you have to be honest with yourself. You have to be planning to take it as a swing, which means you have to manage it as a swing. And if there's no good reason to exit as a scalp, if there's no good reason to exit, don't go exiting as a scalp. Another problem is just the opposite. A beginner takes a trade as a scalp, but manages it as a swing. And in other words, he uses a very wide stop, big risk, for too little profit, very small reward. So if you have risk that is far too big to the reward, compared to the reward, terrible risk reward, you need an extremely high probability to overcome that, to make a profit. So let's look at over here. Let's say a beginner buys up here. He buys the top of a bull flag, and he knows it's a possible double top, but he's thinking, it's an okay scalp. It should go up a little bit. And then he sees a bear reversal bar, and he starts thinking a double top, and he becomes upset. So he has a tight stop right there, but he'd be embarrassed to lose. He doesn't want to feel like a loser. He doesn't want to see himself as buying a scalp at the top of a double top, and he doesn't want to get stopped out right like that. So he knew he was buying the top of a weak rally, that the market was starting to go sideways and converting into a trading range, but he does not want to feel like a loser. So he decides, okay, I don't want to get stopped out there. Maybe I'll use a wider stop. So he lowers the stop down there to increase his probability. He knows that the more you risk, the higher the probability of success. Wider stops have a higher probability of success than tighter stops. However, when you lose more money. If the stops make sense, it doesn't matter whether you use a tight stop or a wide stop. You'll end up making the same amount of money over the long run, but you have to use stops that make sense. So the trader ends up using his wider stop, trying to increase his probability, and he ends up with a loss that's 4 times bigger than his scalping profit goal. And that means he has to have 4 winning scalps to overcome that one loss. So if you're taking a trade as a scalp, and you initially have a scalp stop, use the scalp stop, even if you get stopped out. That's okay. You're going to lose some of the time. All right. You cannot make money as a scalper if you're going to be taking big losses. I'm sorry, I'm a little bit hoarse because I've been talking all day. Anyway, so this trader incorrectly believed that this was a good buy the close trend, and he thought it was going to keep going up and up and up and up. But there was a problem with it. Okay? What he did not consider was, in fact, it was a buy vacuum test of the high close of the day. So you had bulls who bought this close, and they saw the sell-off, they relied on a stop, and they waited for another bull close, and they bought more above. And what's going to happen when it gets back to their first entry? These bulls are going to sell. They're going to sell out, break even on their first entry, and with a profit on their second entry. So instead of this being a good buy the close rally, it was simply the market getting vacuumed up to the high close of the day, and bulls were going to sell. The bears know that, and they're going to sell. So is this a high probability trade? Is this high enough probability for the bulls to buy it for a scalp? No, because probably both bulls and bears are going to be selling. So it's a terrible location for a buy. Also, it's a type of a wedge. You got 3 pushes up, you got a strong bull breakout, first push, second push, third push. So it's also a wedge top. So it's a terrible location for a scalp, which has to be a high probability trade. And that's one of the reasons why You know, scalping is really difficult, especially when you're starting out, because there's so many things going on, you often do not see them until it's too late. I mentioned this earlier, that if you study the market cycle, you know, I pay a lot of attention to the market cycle. You know, is the market in a trend? Is it in a trading range? If it's a trend, is it a strong breakout like this, or is it more of a bull channel? A strong breakout like this on an average chart, maybe 10% of the bars on an average chart are in a strong bull breakout, up or down. So here we have a strong bull breakout, and you know, the only way you're going to make money there is by buying. And it's a high probability buy. Buying here, buying here, buying here, buying at the market, buying anything, buying pullbacks, buying bear bars. High probability that you're going to make money. And you'll probably get a measured move up. Excuse me. At least based on the measured move, based on the size of the breakout. So the strongest part of the breakout is from this open to that close. So probably a 60 or 70% chance the market is going to go up that distance before it falls below the low of this bar.
Hey, Al, I believe you may be muted.
Thank you. I call this a double bottom. Most double bottoms are not perfect. And, you know, this is a lower low double bottom. This is the neckline of the double bottom, and we're breaking above the double bottom. You can simply say it's a breakout above a lower high, breakout above a trading range. Doesn't matter. It's a strong breakout. High probability, 60 or 70%, that you're going to get some kind of a measured move up. So a reasonable thing to do is to buy that close and then look to take profits around the measured move up. And you can see if you did do that, you were not alone. A lot of other traders took profits there as well. Great trader's equation, very positive trader's equation, high probability of a measured move up based upon the initial risk. The initial risk is to below the bottom of that buy climax, maybe the bottom of this, the entire bull leg, but very high probability that you're going to make money. Trader's equation, the probability of making a profit times the size of the intended profit has to be greater than the probability of losing times the size of the possible loss, you know, the distance to your stop. I don't want to talk about actual risk and initial risk, but, you know, that was a reasonable high probability bet. Now, I said that 10% of the bars on any chart are in a strong breakout, and it's usually difficult to make money trading in the opposite direction. So if you sold that breakout, you know, it's going to be very difficult to make money. It's very easy to make money if you buy. Now, if you did sell this breakout and you decided to stay short, how would you manage the trade? Well, the way I would manage it is I would just keep holding. First of all, I would not do that, but if I were doing it, I would keep holding until I get a bear bar like this or that, and then I would add on below. And I would be sufficiently disappointed by the size of this rally so that I probably would try to get out at the midpoint of my two entries. So I sell here, I sell more there, and I'm going to try to exit at the midpoint of my two entries. All right, so I will change my goal from trying to make a profit, selling here, then I'm selling here, not with the goal of making a profit, but with the goal of simply getting out break even. Here's the midpoint of the two entries. And that is a reasonable thing to do. It never fell all the way down to the first entry. So a bear who sold here and sold more there or here, if he held for a profit, he needed it to get all the way down here. It did not get there. It tried to get there repeatedly and did not get there. So there's a gap there. So if you did hold, hoping to make a profit, at some point you have to decide it's not going to happen, and you buy back above a bull bar, maybe above here, maybe above there, and you end up with about a break-even trade. Excuse me. All right, the reality is really hard to hold short, from here all the way over to here. Sell here, sell more here, hold short there. Very difficult way to make money, and in fact, you would not have made money. You would have avoided a loss, but you would not have made money. However, by selling here, even scaling in up here, which is the rational thing to do if you're holding long through all of that, by doing that, you're missing all of these great opportunities to buy. You buy the close, buy the breakout of a bull flag, buy a bear close, buy below a bar, right? Buy above a bar, buy that low, betting the bear breakout will fail. Buy the reversal up, buy above a bear bar, buy below this bar, betting the reversal down will fail. So, and you use the correct stop somewhere down here. But if you took that short and assuming you were able to sell up here and hold all the way to there, all you did through 80 bars was get out break even, and you missed a lot of great buying opportunities. Now, I said that only 10% of the bars are in a strong breakout like this, right? And when they are, you should only be buying. But 90% of the bars are not. They're either in a bull channel or a trading range or a bear channel. And if a trader can manage their trades correctly, that includes using the correct stop, getting out at the right place, especially if they can scale in, a trader can make money at buying or selling at any point. So any point in here, a trader could buy or sell and make money if they manage their trades correctly. At any point, any trade that you take, there's between a 40 and 60% chance the trade will reverse or continue. Through here, there's more than a 60% chance the market is going up. But once you start to enter a trading range, the probability of anything that you do is between 40 and 60%. So the probability of it going down, the probability of you making money selling, the probability of you making money buying is 40 to 60% during 90% of the bars on just about any chart. And if you spend a little time with the math on the trader's equation, you know that even if you only have a 40% probability of making money, if you exit with a reward that's at least 2 times your actual risk, it's a winning strategy. So that means that there's a winning strategy for the bulls and the bears on every bar during this chart. I want to talk a little bit about management. I talked about false beliefs and psychology of causing losses, but bad management is a really common problem for beginners. Now, I said that anytime you buy or sell in here, if you manage your trade correctly, use the correct stop, scale in, and you go for a reward that's twice your risk, you're probably going to make money. Not on every trade, but if you do it over time, you'll probably be okay. So 90% of the bars on any chart, you can make money. And why do traders not make money? And the most common reason is they don't know how to manage their trades well. 90% of the time, you should be able to get out of any reasonable trade break even. In other words, avoiding a loss. And usually you can get out with a profit if you manage well. You can even buy at the top and make money. You can sell at the bottom and make money if you can manage your trades properly. So let's say you look at this and say, trading range, we got a bear breakout. I'm going to sell this bear breakout. So I'm going to sell, we have a double top, neckline, break below the neckline. I'm going to sell that neckline. You say, how can you possibly make money selling at the bottom of a trading range? Well, like I said earlier, if you take a reasonable trade, it's reasonable to take that trade. It's not a high probability trade, but it's reasonable. And you look to add on below a bear bar here or here, what happens? So let's say you take that short and you put a stop maybe 2 or 3 times the height of the bear bar up there. And you just hold, hoping that the market comes all the way back down to your original entry price, and you get out break even on your first entry and a profit on your second entry. Well, look at this. We got down exactly to your entry price, which is that low, and bulls bought. Bears bought, right? You have the bears who sold here at that low, and they're trying to get out break even. A lot of those bears sold more here or here, and they're trying to get out with a profit on their second entry and break even on their first. So if you don't get filled here, you clearly don't get filled here or here, it's probably worth exiting on the reversal up. And you end up losing a little bit of money on that first sell, but you made more money on that second sell. So by managing your trade correctly, you can sell at the low and make money. Let's look at the opposite. Let's say you see a rally and you buy that close. You think, oh, it's a buy the close rally. I'm going to buy the close, buy. I'll buy any of these closes. And let's say this is the one that you chose to buy. Stop has to be below the bottom of a major high or low, a breakout to a new high. So you're buying far above the moving average. You're buying after several doji bars. Not a great location to buy. But if you did do that buy and you manage your trade correctly, what happens? Well, like I said, you buy that and you look for a bull bar, not here. Here. Maybe I'll buy more here above the high of this bar and get long there. If you do, you're probably going to try to get out break even on your first entry right there, and then a scalper's profit on your second entry. So even though you bought the high close, you were able to avoid a loss if you managed the trade correctly, and you probably made a little bit of money on a scalp with that second buy above that bull bar. Now, experienced traders, they sometimes do stupid things. They take bad trades. They take a trade, at the time that they took it, they didn't realize some things about it, and they didn't realize it was a bad trade. So they took a trade where they did not structure the trade to have a positive trader's equation. And obviously, if they knew that in advance, they wouldn't take the trade. However, they presumably would notice it pretty soon after entering, and experts are really good at minimizing their losses. They manage their trades really well. So let's say you see a big bear bar here, breaking below that low, and you say, I'm going to sell that close. Okay? Let's say this is a breakout above yesterday's high, and we're reversing down, and you're saying, okay, we got a micro double top, we went up, we went down, we went up again, and this is the neckline of the micro double top, or maybe this is the neckline of the micro double top. In any case, you're getting a bear breakout close below the moving average, close below that low. It's a reasonably good sell. All right, higher probability to not sell that close and wait for one more bar, wait for a confirmation bar. Here I talked about a bull bar and then a confirmation bar and another confirmation bar. So it's higher probability making money buying that close or this close than it is buying this close, a series of consecutive bull bars. Here you have a single bear bar, a bear breakout. It's higher probability to wait for one more bear bar and then sell closes. So if you're a bear, an expert bear, and you sold that close and you see this bull bar, what are you thinking? You're thinking, darn, I didn't want that. That's bad follow through, right? And you try to get out break even. So you see this bull bar, you immediately place a limit order to get out break even. And look at this. The low of this bar did not fill your order, so you're stuck in the trade, right? So what do? You got to get out on the reversal up. So you're disappointed by the follow-through, you try to get out break even, you do not get filled. And what you're going to do is you take the loss, right? So the experienced trader who took that trade understood what was going on, bad follow-through, so disappointed bears trying to get out break even. They tried to get out here, they could not, and if it's starting to go up, he wants to get out, and he gets out at the earliest possible time. Okay. Now, in fact, if he did do that, he could end up being in a position to do the right thing. We got a bull breakout, good follow through, buy that close, and it more than made up for that loss. So that's the ideal way to trade it. Okay, I want to speed up a little bit here because I want to make sure I get through things. Okay, bad trader's equation. So we got a bull trend, a pullback, you have a high one buy, you got a second leg down, a high two buy. So, excuse me. So maybe you buy the high 2 and put a stop below the low of that bar. Okay? The signal bar is not all that big. The risk is not all that big. All right? Now, why would a beginner lose money? He's doing something he should not do. Okay? It's a bad trade. Here we have, 8 or 9 bars without a bull body, and he's looking to buy? No. A really tight bear channel. The best the bulls could do is a small breakout like that. Should he be buying here? No, it's a bad trade. It's really hard to structure a positive trader's equation taking that buy. A bad trade means either the probability is too low or the risk-reward ratio is too bad, and it makes it really hard, almost impossible to structure a positive trader's equation trade. And buying in a situation like this is basically a breakout on a higher time frame chart. This is a bear breakout, and you certainly don't want to be buying. All you should be doing is selling. Again, beginners like to scalp because all they see is risk, right? But reward is, but the biggest problem, if you're scalping, the reward is small, so you have small risk, but you have small reward, and that means you can win 60% of the time and still lose money, right? So to be a scalper, a lot of times you have to be winning 80 or 90% of the time, and some traders can do that, most traders cannot, and it's unrealistic to assume that you'll be one of those traders who can. Most successful, profitable traders are not winning 80 or 90% of the time. The successful, profitable scalpers are, but they're a minority. The vast majority of successful, profitable traders are winning 40% of the time, maybe 50% of the time, and they're looking for swing trades. Okay, low risk almost always means low probability. And a minor reversal like this means really low reward. It's probably not going to go up very far. So instead of buying, you should only be looking to sell. Okay, so an experienced trader, instead of buying that reversal, will look at that and he'll sell above this bear bar, betting that it's not going to go up very far and we're going to go lower. I also talked about managing trades badly, which is common for a beginner. So he might buy this and say, we got a bull bar, we got another bull bar. I'm going to scale in and buy more lower. So he buys more here, and then at some point he finally gives up. He exits with a loss that is very big, and it's on a double position. So now he has a really big loss, much more than he ever would reasonably ever want to take, and he'll have to have a lot of wins to make up for that. All right, okay, let's say over here, instead of a bear, let's talk about a bull case. So let's say the market's going up for 10 or 20 bars, and the beginner sees this bull bar and he says, oh, that's a pretty good bull bar. I'm going to buy that close. Al says that if you get a bull breakout, buying closes is a good thing. But the problem is if you're buying, or it's the same thing down here. The beginner keeps waiting to sell, and he says, oh, look at this. We're starting to accelerate downward. I'm going to sell this close. We got consecutive bear bars. Al says that's a good thing. It's a good thing early in a trend. It's a bad thing late in a trend. If you get a strong breakout late in a trend, it's more likely to be an exhaustive end of the trend than the start of a new leg down. So beginners are often taking trades where they're buying high at a buy climax and selling low at a sell climax, and it's better to do the opposite. Again, beginners, all they think about is risk. If they lose money, they're afraid that their account will die and their career as a trader will die. And he's thinking, I want a high probability trade, and we finally get a bull breakout, I'm going to buy high. Finally get a really strong bear breakout, I'm finally going to buy low. And he thinks it's a confirmation of the trend, and he doesn't consider the possibility that it could be a climactic end of the trend. And that it's, you can look at this and say, I'm going to sell this bear breakout. Surely it's going to go down. Surely the institutions will allow me to make a little bit of a profit. There should be at least a little bit of follow through here. And that's just not the way the world works. No one cares. No one even knows you exist as a trader. So no one's certainly going to care whether or not you make money. Beginners, as I said, they lose money by doing things they should not do. He looks at this and says, it's a high to buy. Okay. He knows the probability is low. We've had 8 bear bars. He knows the probability is low, and he knows it's in an obvious bear trend, and he does not exit immediately. He sees the micro double top. We're up, we're down, we're up, and this is where he should exit, right? Because bears will be selling. It's a bear flag, bear trend, a pullback to the moving average, bear bar closing on its low. Bears will be selling there, but the beginner does not take the immediate exit. He does not put a stop in the market. He keeps the stop in his head, and he does not exit as the market falls below his mental stop, and he just ends up losing a lot. Okay. So here we got a bear breakout, and a bear follow through bar. It's a good sell. We've had 7 or 8 bars down. It's good to sell that. But a lot of times the beginners will manage the trade badly. They know the market's always in short. They know it's in a bear trend. They know it's probably going to go down. And they know the stop belongs either here or even better, up here. So the beginner knows where the appropriate stop is. But, if the stop is 3 times bigger than what he normally uses, what does he got to do? He has to trade 1/3 his normal size. And when beginners see that, let's say the beginner decides that he's going to trade his normal size. Even if he trades the correct size and trades smaller, he decides, I don't want to risk that much, right? All he thinks about is risk. That's too much risk. I don't want to risk that much. And he ends up ignoring probability. He ends up ignoring reward. You have to use an appropriate stop, and the market it has to be appropriate for the market as it is right now. And the stop cannot be too tight. So if you're selling down here, your stop has to be here or here. And if you're not putting that stop up there, you're managing the trade incorrectly. You're managing the trade badly, and that's a sure way to lose money. And if you are going to be risking much more than you normally risk, right? If you are risking a lot so that you're uncomfortable, and you take this short, you have to trade really small. And if your account is not, if you cannot trade small enough, you cannot take the trade. In any case, a beginner who's afraid of risking that much money, he's going to look for any excuse to exit because it's too painful. He just does not want to risk that much. He knows where the stop has to be, and he knows it's probably going down, and he'll just he'll take that short, and he'll say, it's a high to buy. I got to get out above this bar or above that bar. He never intended to rely on the appropriate stop. He just couldn't take the pain, and he took a good trade and he lost. All right, so I talked a little bit about beginners losing because of psychology and false beliefs, especially the belief that there are perfect setups. There are no perfect setups. There are setups on every bar, on every chart, and if you learn how to read the charts, you can enter at any time all day long. Waiting for a perfect setup, it's fiction. There are no perfect, nobody has secret perfect trades. There is no thing as noise, no such thing as noise. Every bar has a lot of volume, and that means institutions are finding reasons to buy and sell every bar and every chart. And during 90% of the bars on every chart, you can buy or sell and make money if you manage your trade correctly. A lot of times that requires scaling in, which beginners should not do, but experienced traders will scale in to increase their probability. By increasing their probability, they increase their risk, but if they manage the trade correctly, they can usually avoid a loss. And then a big problem with beginners is management, and the single biggest problem is all they see is risk. They don't think about reward, and especially they do not think about probability. They're thinking, what if it works this time? I'll try it this time. What they're saying is they're taking a low probability bet, and you really have to be aware of probability as a trader. I'm Al Brooks, and this is part of one of the videos from the Brooks Trading course. And I'm ready. Terry, do you have any questions lined up?
Sure. Let's see. What is the average distance, in your opinion, between a scalp stop and a swing stop?
Well, in general, let's talk about the E-mini. In general, an E-mini scalp I think of as 1 to 2 points, and if you go for 4 points or more, I think of it as a swing trade. I don't have time to talk about the math of it, but that's the reality. So scalp is 1 to 2 points, and swing stop is 4 points. A swing trade is 4 points or more. And the more, in general, if you're using a 1-point stop in the E-mini, you're going to lose money. If you're using a 2-point stop in the E-mini and you're not flexible with moving the stop and scaling in, you're going to lose money. So a lot of E-mini scalpers who are scalping for 1 or 2 points are oftentimes risking 4 or 5 or 6 points, but their initial entry is small and they're willing to scale in. And that's one of the difficult things that exists for beginners. They try to use stops that are too tight. They try to use a 1-point stop and try to scalp for 1 point. They're going to lose money. So you have to, even as a scalper, a 1-point stop and usually a 2-point stop is too tight.
Okay. Let's see. Okay, you just defined scalp. Can you address the issue of taking trades under the influence of fear of missing out? Usually you end up buying at resistance. How do you deal with the fear of missing out?
Oh, that's called a FOMO trade, fear of missing out. And in general, what you're talking about is a breakout trade. So if the market is selling off, if the market looks like this, right, the market's going down and you're afraid of missing out. And what you're afraid of is risk. If you're selling in here, the stop is way up here and you don't want to risk that much. And the obvious thing is you have to trade really, really small. In general, if I'm in a FOMO, if I see a FOMO setup, a strong breakout, and I have to get in, I just, in this case, a bear trend, I sell at the market. I don't worry about it. I just sell. I got to sell. If it's going down, I got to sell, right? But I trade small, and because I know I have to risk much because we could get a big bounce like this. If you sold that close, you still made money if you used the correct stop, right? So you sell it, and then you add on a couple points higher, and then you get off break even when it tested that close. So, FOMO trade, the best way to trade it is you have to trade small and use the correct stop. And if you have to be able to trade the I don't care size. You have to be able to trade so small that if your stop gets hit, you don't care. Obviously, you always care, but it won't be so painful that you'll say, oh my gosh, I just gave back a week's worth of profit. You cannot do that. All right, so you just, the most important thing with a FOMO setup, you just sell the market and you use the appropriate stop. And if you cannot trade small enough to use that stop, you just wait for a pullback.
Okay. How many traders do you think trade always in versus scaling in?
I think most traders do not trade always in, but I think it's a good way to trade. Always in means you're constantly in the market. If it's going up, you're long. If it's going down, you're short. Most traders, if they're, let's say it's going up and it's always in long and you're long. Most traders will get out in pieces and then sometimes they'll miss the final part of the rally and then they'll wait for a reasonable setup and they'll go short. So a lot of times they'll be flat, part of the time. And as far as scaling in goes, you hear about it all the time. Warren Buffett, he scales into trades. If you watch Fast Money, every now and then they talk about Call Icon scaling into trades. And I remember there was one trade, I forgot which market it was, last year or something. They said Call Icon just scaled in for the seventh time in the trade as the market continued to fall. And if you pay attention to what they're saying in Fast Money, I keep track of a lot of the stuff they talk about in Fast Money. For example, Carl Icahn with his scaling in. And the math, he does really, really well. I think he bought Freeport-McMoRan at 10. I think he scaled in at 5, and now it's whatever it is, 15 or 20 or something. So at the time when he bought it at 10 and it fell to 5, you think, God, Carl Icahn's an idiot. He lost 50%. Well, he didn't lose 50%. He bought more, and now it's up at 15 or 20, and he's made 100% or 200% or 300%. So, scaling in, dollar cost averaging, that's scaling in, and that's a reasonable thing for, people who are managing their portfolios to do. So, it's a reasonable thing to do. But aggressive scaling in as a day trader, that's something else. And, I think that is something you should not do as a beginner. However, experienced traders, I think a lot of experienced traders do it because it's a really good way to improve your profit profile.
Okay. At what point is scaling in becoming adding to a loser? And at what point do you decide that the market is against you and you should exit all your positions?
Well, there are two kinds of scaling in. I have videos about that. One is you're scaling in as the market's going in your direction. So you buy, it goes up, you buy more, right? And then what you're talking about is scaling into a losing trade. So you buy, it goes down, and you buy more. And when you take any trade, when I take any trade, I always have a plan. Is this a trade where I'm planning on scaling in if it goes down? If I am going to scale in, how much am I going to add? What's the size of my initial position? The first thing I look at on any trade is where's my stop? And then I look at the strength of the market. Does this look like, a reasonable market? Should I be thinking about scaling in? A lot of times, I don't pick the exact bottom, I don't pick the exact top, and I don't worry about it. If I believe the market is bottoming, I'm going to buy and use an appropriate stop, which might be below the current low. That's okay, right? As long as I use an appropriate stop and an appropriate distance, typically I'll look to scale in. So let's say, for example, I thought this was a terrible sell climax and we were going to bounce. Let's say I bought, that close and it goes up here. What am I going to do? I'll probably try to buy more lower if my premise is that this is a sell climax that's going to reverse up. Or if I bought this high and I think that it's probably not going to go down much more, I might buy more at that low and just use a stop that's some kind of a measured move down, maybe based on the height of this final part of the sell climax.
Okay. How do you determine, or how are you estimating reward prior to the trade?
I'm always thinking about a couple things. I'm always thinking about measured moves. Anyone who's familiar with what I talk about measured moves all the time. I gave one example in this video today, in this presentation today, but I'm always thinking about measured moves. So if I'm looking for a swing trade, up or down, let's say a swing trade up, I'm always trying to think, is there something going on here that should result in a measured move of some kind? And if there is, I want to take at least part of my position off at that target. If the move up is weak, I'll be taking parts off as it goes up. But if it's strong, I'll try to hold as much of my position as I can until it reaches that target, and then I'll take part or all off depending on what's going on. Anytime I enter a trade, I always have a reasonable location for a stop, and I always have an expectation. Where is a reasonable place to take a profit? Is this a swing? Is it a scalp? I always have a goal going in. And if it's a swing, how far up do I think it's reasonable? Where do I think it'll go? And again, I talk about this elsewhere. I did not talk about that in this particular video.
Okay. What part does momentum play in choosing your entries?
Now, I talked about the market cycle. I said the market's either in a trend or in a trading range. And if it's in a trend, it's either in a breakout or a channel. And, you're talking about a momentum trade, which usually means a breakout. And I love breakout trades because the probability is high. However, they can be paralyzing because the market's moving so fast, it's really easy to be terrified of taking an entry. But I love high momentum trades. And it's what we were talking about a few minutes ago, a FOMO trade, fear of missing out. And if the market's going down like this, I usually just hit the button, sell the market, and use the appropriate stop it's like jumping off a high diving board. You know, if you're a kid, you're up there and you're terrified, and finally you jump and you curl up into a ball. Every muscle is tightened up. Your eyes are closed tight. You're holding your nose, but a few seconds later, victory. You know, you completed the dive and you're really happy. And that's true with FOMO trades as well. They're always scary when you take them, but momentum is really strong, and you know you're afraid briefly, but probably pretty quickly you're going to end up with a profit. Momentum trade is the opposite of a value trade. A value trade is like entering on a pullback, because if you're buying a pullback in a bull trend, you're buying because it's cheap. If you're selling a breakout, you're selling because it's going down, not because it's too expensive. You're selling, you don't care about what the price is. All you know is that the market's going down, and if I sell, it's going to go lower. So every trade is usually either a momentum trade, a breakout, or a value trade, a pullback type of trade.
Okay, if a trading range probability is 40 to 60%, then what is the probability for a trend?
Well, it depends. If it's a breakout, I talked about that earlier.
Yes.
So when I see a strong breakout like this and a follow-through bar like this, probably 70% chance or more that we're going to get a measured move down from the open of this bar to the close of that bar. And I don't have it drawn in here, but this low is probably right around the measured move based upon the height of this breakout, the open of that bar to the close of this bar, measured move down.
Okay.
So a strong breakout probability usually is 60 to 70% of some kind of a measured move projection.
Okay. How do you calculate the minimum scalp size in any market? Is it based on the average bar size?
Yeah, well, I talk a lot about that elsewhere as well. One of the beautiful things about the E-mini is, I could talk about the math of it, but let me just say the E-mini minimum scalp size is 1 point. For pips, let's say you're forex trading, the minimum scalp size is 10 pips, maybe 20 pips. For crude oil, if the market is small, 10 cents. If it's big, 20 cents. If it's really big, 50 cents. Stocks, if it's a cheap stock, 10 cents. Right? There are mathematical reasons for that. But one of the beauties of the E-mini for day traders is the average bar is more than 4 pips, 1 point. So why is that important? That means that you can find a scalp on almost every bar. If the average bar is bigger than the minimum scalp size, there is an incredible number of scalps on the E-mini chart. On a day session in the E-mini, there are 81 bars, and there probably are at least 40 reasonable 1-point scalps, and probably on an average day 20 reasonable 2-point scalps. Nobody's going to take all of them, but they're there. If you know how to read the charts, they are there.
Okay. How much full-time study do you think, let's see, how much full-time study do you think before, okay, I got to reword this for the person. How much full-time study do you think is required before a person can be in position to trade successfully?
That's really interesting. I've received countless emails from traders who are doing really well, thank you emails. And, some of them, it took years. It took me 10 years to figure it out. But I didn't, Big Mike talked about all the dishonest people out there. There really are a lot of dishonest people out there. And, I went through just about every one of them back in the 80s until I decided that the only way I'm going to do it is on my own. So I just got rid of everything and started out by myself. I've had emails from traders who have become, making thousands of dollars a day within 6 to 12 months. That's unusual. But I can tell you that the traders who are making thousands of dollars a day, every one of them has spent an incredible amount of time, studying what they're doing. A lot of them, they've, taken notes on my books and my videos that are almost as long as my books. So, I think the more you learn and the more you study and the more, Mike talked about, keeping a diary and studying what you're doing. That is really, really important. And, I did that for years and years and years. I used to print out every chart and I would look at every trade I took. I would try to be as objective as I could about my winners and my losers. And I would look at every trade I did not take. I looked at every possible setup. And over time, I started to discover that there are reasons to enter on almost every bar. So as far as answering your question goes, how long does it take? Every person's different. It took me 10 years, but I didn't have anybody, handing it to me. I was getting lied to by all kinds of people. But, if you work really, really hard and you're really honest with yourself, and you put in the time, it's going to take you some time. I don't see anybody getting consistently profitable in less than 6 months or a year. But, if you put in the time and you really got to do a lot of work, you can make a lot of money, and it doesn't take all that long, right? As I said, I've heard from a lot of people who have put in a lot of time and who are making a lot of money.
Speaking of trading journals, what kind of information and metrics do you think a person should record about their trading to make the journal worthwhile?
Well, I've had traders at all kinds of doing everything. I've had traders, who are really into the mathematics of it, and they look into all kinds of measurements of portfolio performance. And I think, which is entertaining, but I don't think it makes you a better trader. I think it's more important just to, analyze your trades. Al says I should put a stop here. Did I put my stop there? Al says that if the market's clearly showing that my premise is no longer valid, did I get out? Are you doing the right things? I think that should be the focus. Here's a breakout trade. Oh, I know I should have taken that trade. I didn't take it. Why didn't I not take it? Was I scared? Was my stop too far? Was my position size too big? I think, the basic stuff, just going over the chart, going over what you did and asking yourself, did I do the right thing? Why did I not do the right thing? How can I learn how to do the right thing the next time I'm in this situation? So I think that the psychology, the analysis of self, I think is, probably the most important thing. You don't have to be a genius to look at this and say, oh, I got to sell, right? Anybody looking at this knows you got to sell, right? But, did you take the trade? If you did take the trade, did you manage it correctly? Did you put the stop in the right place? Did you trade small enough? So a lot of the actual entry stuff and setups are obvious, but, I think you really have to analyze, what your behavior was and, why you did certain things and what things you can do better the next time you're confronted with the same circumstances.
Okay. What are the early signs of going into a trend versus staying in a trading range?
Well, let's take a look at this right here. Okay? I'm always looking, bear trend. I'm always looking for bear bars. We got a bear bar here, but then we got a bull bar here, bull body. Not, we got a bear bar here, not very big, and then a small bear bar here, not very big. So this could still be a bear leg in a trading range. Okay? But then we got a bear bar here and another bear bar, and then the absence of a bull bar, and then another bear bar, right? So what I'm looking for, if I'm looking for a trading range to convert into a breakout, in this case a bear breakout, I want to start to see consecutive bear bars, 2, 3, 4, 5 of them. I want to see closes below the midpoint. These closes are below the midpoint. I prefer to see closes on the low, and then I'd like to see bars getting big, like this, a big bear bar closing on its low, and then a second big bear bar closing on its low. So consecutive bear bars, closing below the midpoint, bars getting bigger. So the more bear bars, the better. If I'm seeing a bear bar here and then bad follow through, probably a trading range. A bull bar here, bad follow through. Bull bar here, bad follow through. Probably a bull leg in a trading range. Bull bar here, bad follow through. Reversal, so terrible follow through. So I want to see good follow through, and I want to see the market well below prior bars. So here we're starting to break well below a trading range. And then we're starting to get consecutive bear bars with closes below the midpoint, and then we're starting to get big bear bars. All of that increases the probability that the market's going to fall for some kind of a measured move.
Okay. As a beginner, should we begin with paper trading or should we begin with real trading? And I guess kind of to expand on that, at what point do you think a trader has to move from sim to live?
Well, everyone starts with paper trading. They look at the chart and say, oh, I should have sold. That looks like a good sell, right? So everyone starts with that. And if I sold that, where would I put my stop? And one of the things about paper trading is people lie. And I lied to myself all the time. When I started out and I was paper trading, so I'd say, oh, this is obvious. I got to sell here. I'm going to put my stop up here. And I'll make all this money down here. And I would get out on this close or on this reversal up. It's just all lies, right? And or else, a lot of times I would paper trade, and at the end of the day, I would say, oh, I bought here. Well, it's clearly a bad buy. So I'm gonna cross that trade out. I'm gonna delete that from my collection of paper trades. And all of a sudden, my performance was outstanding. And with paper trading, you can cheat. With real money, you cannot. But one of the problems with real money is if you want to trade the E-mini, the money is big. So even trading small, even trading a single contract, it's more than probably most traders are comfortable risking as a beginner. You can try trading stocks, like XIV, VIX. Those are decent ETFs for day traders. But then you have the problem of portfolio size. If you're a day trader, I think the minimum portfolio size is $25,000. And then you have one other option. Well, you could also trade Spider, SPY, weekly options. That's another alternative. But it's really, the bid-ask spread is hard and the time decay is really bad. So a good place for traders to start is with Forex markets. And that's because you can trade incredibly tiny positions. So instead of trading 100,000 units, you can start by trading even 1,000 units or 10,000 units. I know the argument, Al, if I only trade 1,000 units, I'm never going to get rich. That's right. You will not get rich trading 1,000 euro versus $1 units. But you're also never going to get poor. So it's an opportunity to trade with real money and keep real score and deal with feelings that are much more real than you'd get with paper trading. So I think, beginning trading with, also a lot of times with paper trading and simulated trading, you don't get the slippage that you do in the real world. You get better fills, you get theoretical fills and not real fills. So they're better, and it makes your performance look better than it really is. So I think a really good place to start is with Forex markets and just trade really tiny positions until you're comfortable and then work your way up. And then once you get good, if you want to trade other markets like the E-mini, which is probably the best day trading market because, as I said, the minimum scalp size is smaller than the average bar size on a 5-minute chart. So there are so many trades all day long, right? So for a day trader, the E-mini is a fantastic market. However, for a beginner starting out, Forex markets are really good because you can trade really small positions.
Okay. Speaking of Forex, have you looked at any of the microcurrency futures? I think for some people that might be an excellent opportunity to trade futures at a small margin, small tick size.
Years ago, the micro stuff was popular, and the reason I never traded it is because I thought the overhead would be too big, slippage, bid-ask spreads and stuff. If there's something in it for you, there's got to be something in it for the other guy. The other guy is the broker. So if he's going to be handling positions that are just as much work as, somebody trading 100 E-minis, right? It's just, the computer overhead is the same as a guy trading, some micro, futures contract, right? So the institution wants to be rewarded, and he's got to charge fees that make it worthwhile. So if he's making more money then you have bigger overhead to overcome. So, I personally would not trade micro contracts. I would do something else, like I said, trade Forex contracts or, or try to get a big enough account that would allow you to trade ETFs, ones with really big volume. Over time, different ones become popular. The Spider is obviously always popular, but over the past couple of years, VXX and XIV are really popular. They have hundreds of thousands of contracts every 5 minutes. So, really good trading vehicles. But as far as the mini micro stuff, the broker is going to stick it to you so you have more overhead, and I think it's hard to make money.
Okay. Speaking of these different markets, do you trade the different markets differently? Say, like the ES versus the bonds or anything of that nature?
I use the same price action approach with everything that I trade, but there are some things different. So, for example, in a Forex market, the average bar, 5-minute bar might be 6 ticks, 8 ticks tall. And the minimum scalp for me is 10 pips. So, that means there are going to be far fewer trades than there are in the E-mini. But beyond that, I trade them exactly the same. Every market exactly the same. If you think about it, the markets are all being traded by the same people. Everyone is making trades based upon rational behavior, rational human behavior. And, no market is irrational. No American market, no big volume market is going to be irrational, because no one would trade it. So, it doesn't matter what chart, what time frame, what market that you're trading, it's all going to be traded rationally. More and more of it is going to be traded by computers. Also other international markets, foreign markets, they're going to become increasingly computerized. So everything is going to become like the E-mini, which I consider basically a perfect market. And so, I trade everything the same. As long as we're the same. When I look at charts from 100 years ago, and I've looked at a lot of charts from 100 years ago, if I remove the price scale and the time scale, the charts look exactly the same as charts today. If I look at a Forex chart and remove the price scale and the time scale, it looks exactly like a spider chart or an Apple chart or a crude oil chart or a gold chart. They all look the same. I'm going to trade them the same.
Okay. Let's see. I'm scrolling through some of the questions.
I'm beginning to lose my voice, Terry.
All right, I'm trying to get one or two more in, and then we'll wrap it.
Yeah, because I talked all day and then I talk now, so I'm getting a little bit hoarse.
There's quite a few, and there's quite a few of stuff you've already talked, so I'm trying to get through the one you already covered to maybe some different ideas.
Okay. Plus I'm an old guy now, too.
Actually, that looks like about all I'm going to do, because most of the questions are the same or topics I'm not going to cover. So lots of good comments, people saying thank you for the presentation, very useful points. Okay, I'll leave this with the last question. How do you balance life and trading? And then that'll be it.
Well, it's really interesting that you ask that. I'm in a transition point in my life for various reasons. One is my 3 girls left about 10 years ago. They're doing well. One went to Stanford Law School, the other one went to Harvard Business School, another one went to Michigan Law School. But I never get to see them. So, it makes me a little bit sad, a little bit lonely. And, they were my life, a big part of my life for, so many years. And now, my life is different. I'm also single and living by myself. And, a lot of, as I said, I'm almost 65. All of the fun things I wanted to do in life, I've already done. So it's less important for me to do them. Now, the one thing that I enjoy the most is trying to put into words what I'm doing as a trader. I really enjoy trying to put it into words and try to be clear about it. And so, right now I'm spending, most of my time, trying to, create videos and, studying charts. I still study charts all the time. I play tennis several days a week. I run several days a week. I lift weights several days a week. And I, hang with my buddies some. But I really like being by myself, thinking. That's the most enjoyable thing to me, is thinking. I want to say something with respect to that. Next week I'm going to Boston. My mother turns 103, and you know, she cannot walk. You know, she's incontinent. She wears diapers. She can barely hear, but she has an incredible IQ, and she reads several books a week. You know, she just lies in her bed. She, you know, rings the bell, and they come by and help her with the bathroom and take her to the eating place. One of my daughters, Tess, just graduated. She just got her MBA from Harvard this year, and she and her boyfriend, fiance, he is getting his PhD in computer engineering at Harvard this spring. They went over to visit her over the weekend, and they played Scrabble with her. And Tess, who is really, really bright, said, "Dad, it was really hard to beat Grammy. I barely beat her, and she killed Joey." You know, and so here you get this 103-year-old woman, you know, beating up on these two Harvard kids, and you know, what she does all day long. She can't do much of anything else other than think, and that's what she does. And it's just absolutely, it's miraculous that you know, that she's doing it at that age. For me, I enjoy thinking too. I enjoy sitting down by myself and just writing or reading or, you know, thinking about things, studying charts. I'm always looking at charts, and you know, but I'm at a point in my life when I can do that, because I don't have to coach softball. I don't have to coach volleyball. I don't have to, you know, drive every weekend to San Francisco or LA, you know, to, you know, a soccer tournament or a softball tournament or a basketball tournament, or, you know, or a band concert or something. So, you know, I'm at a point in my life when I can, you know, just do this, which it makes me happy. So my life is unbalanced. I spend way too much time, you know, studying charts and doing trading related stuff, but I'm really happy, and you know, I accept that. I don't worry about other things.
Thank you for the story, Al, and thank you for the webinar and everything. Great content. Thank you for your time. Lots of good comments. Again, people saying thank you and really enjoying the webinar. Thank you for your time today.
All right, I appreciate it, Terry. I thank everyone for listening in, and I also thank Big Mike for giving me the opportunity. Good luck to everybody.
Just a little comment. I believe we will be back together in February.
Yes, you know, I'll talk about losing because of bad luck instead of here. I talked. This is part of one of the videos on losing because of mistakes, and in February I'll talk about the other side of it. You know, a good trader losing simply because of bad math. You know, they do the right thing, but sometimes you still lose, and how do you handle it?
Okay, and that'll be February 21st. So look forward to talking to you then.
Okay, appreciate it. Thank you.
Bye.
Bye-bye.